Energy investor Eric Nuttall, well known to our audience. He's a senior portfolio manager at Ninepoint Partners. And for a broader market view, we're pleased to have back with us Mike O'Rourke. Mike is chief market strategist at JonesTrading. Good morning to both of you. And Eric Nuttall, let me start with you on that subject of $100 oil. Do you think prices will reach $100?
I do, and it's, we all get infatuated with trying to identify exact prices. I just think the direction is up. What we saw 3 weeks ago was this divergence between the financial market for oil and the physical, where you had the largest unwinding of crude contracts in history, driving the oil price down 15%. I think OPEC just got tired of the tail wagging the dog, that financial market for oil being much, much bigger than the physical. And they needed to do something bold to restore the market's conviction that the narrative around, looming recession and such isn't going to drive price. So we think price of oil now is mispriced relative to where inventories are. We have, irrespective of weakening financial conditions in the US and Europe, oil inventories globally ending this year at a 7 to 8 year low. That was before the OPEC cut, and that cut just now doubled the pace of draws. So we think essentially OPEC is going to over-tighten the market. The price is going to spike higher, and they're actually going to have to unwind these cuts by the end of the year.
Mike, what's your view?
I think Eric makes a lot of good points there. The way I look at it from a stock market perspective is the stock market is trying to price in this very soft landing recovery, which again will drive oil prices higher if that's the case. Meanwhile, there is the risk down the line that we do see economic slowing, and that will make the outlook more challenging for oil towards the end of the year. But for right now, for what the stock market is predicting, oil should be going higher.
Now, what is your view on the market itself, Mike? The fact that we have seen that notable rally to start the year, maybe not in energy stocks up until yesterday, but this view that this belief on interest rates or hikes being done is just not the reality.
Well, it may or may not be the reality. Obviously, the Fed's planning at least one more rate hike, and we'll probably definitely get that. And then from there on out, I think what's key here is going forward, we're going to be in a positive, a real Fed funds rate environment, or basically the tightest monetary policy environment we've seen in 15 years at least. And that, I think, will wear on the economy as you go out to the second half of the year. But for right now, the U.S. equity market doesn't seem to care about that. But we also have to keep in mind, about 90% of the S&P 500 gains in Q1 were driven by 7 stocks. So there is that risk out there.
Yeah, that's a helpful context point. Seen a lot of research on Wall Street circulating on that very point about the weightings in the S&P 500. Eric Nuttall, the comment on where the economy goes from here, because of these higher interest rates, we're only like a week removed from what felt like very real banking turmoil, and we saw the price of oil under pressure in that scenario. So how does the oil market navigate, on the one hand, what could be this tight supply picture versus the concerns on the demand side if the economy weakens?
John, it's an excellent question to ask, because I think that's been a concern people have been having. You can have draws in inventory, tightening market, but then still this fear of a looming recession will prevent the oil price from reflecting fundamentals. I think that was why OPEC acted as boldly as they did. And as a reminder, you can still have a recession. We'd reference Energy Aspects, who models a recession in Europe and the US having demand fall by about 600,000 barrels per day. But the real story for the past decade plus has been about emerging economies. And so they're modeling about 1 million barrels per day of demand normalization from China, combined with non-OECD growth of another million. And so you were already in an undersupplied market, and you can have a recession in OECD countries. But the demand normalization from China plus non-OECD more than overwhelms that. So I think it's going to be the magnitude of the draws. We're now out of the seasonally weakest period of demand for oil, Q1. We've got refineries coming on. We've got this strike in France that at some point will revolve. So the worst should be behind us, and the pace of draws, I think, are going to surprise people in terms of their magnitude, and that the extent of that, I think, will be able to jolt people from this comatose state of just having to always worry about a recession, and therefore the demand for oil must fall. I do not believe that narrative.
Mike O'Rourke, just looking at the performance, Eric was talking about the first quarter. Energy stocks did lag during that period. You talked a lot about financials. We didn't know necessarily you'd see the collapse of regional banks, but that group was under pressure. And to your earlier point, tech was the outperformer. For those who are trying to strategize for the rest of the year, or at the very least least the next 3 months, what would you be recommending?
Well, what we saw in Q1 was people hid in the mega cap names. They saw them as haven plays in a market where people are still hesitant to take money out of the tape. What I think we saw yesterday was interesting. We saw a lot of different behavior. As you mentioned, energy had a big pop yesterday. Managed care had a good session yesterday after being down 11% in Q1 because of news from Medicare. So you are seeing different pockets of the market come to life as people express a little bit less fear about the banking industry. And I think that's what you need. Just in general, you can't have the entire market hiding in 7 names and call that a good performance and a healthy stock market. So broadening out would be beneficial, but as you probably know, I still think there's a lot of risk because I don't think the economy is used to this interest rate environment that we have right now, and it's going to take time to process that.
So obviously keeping that uncertainty in mind, Eric, you're generally upbeat on the prospects longer term for a lot of the energy companies themselves. You talk a lot about them on Market Call, but before we go, we only have about 30 seconds left. The kinds of energy companies that you're championing as an investor right now.
The only thing I want to own right now are Canadian heavy oil producers. You get the strongest balance sheets in history, the most amount of free cash flow in history, and they return at 50 to 100% of the free cash flow back to us to drive a re-rating. That's the only thing I want to own and what I'm focused on.
Okay, Eric, great.